Start with this very informative article that came out just a couple of weeks ago. Its title goes, Companies' Climate Risks Are Often Unknown. Here is how one opened up. Um, Look at which newspaper that published this article. It was Wall Street Journal, not New York Times. And it was very informative. It talks about the case of Hewlett Packard Enterprise that was hit hard by the Hurricane Harvey in 2017, and it reported about 93 million dollar of damages, storm damages that are not covered by the insurance. And the company subsequently decided to move to other locations than Houston area. If you haven't done so, I would highly recommend you to read this article. Here is what our Treasury Secretary said, that both the impact of climate change itself and policies to address it could have major impacts, creating stranded assets, generating large changes in asset prices, credit risks, and so forth that could affect the financial system. These are very real risks. And this is very similar statement to the Mark Carney's statement earlier. Mark Carney is the mastermind of the TCFD, and he was the former governor of Bank of England and the chairman of the Financial Stability Board. And he said the catastrophic impacts of climate change will be felt beyond the traditional horizons of most banks, investors, and financial policymakers. I think that to me, what is very interesting is that, well, these bold statements are all coming from the finance and investment communities. And this is, in my humble opinion, why those financial and investment communities are making this bold statement against climate change. Let's just look at the case of PG&E. As many of you know, PG&E was accused of as the cause of the several wildfires in California, and it subsequently filed a Chapter 11 bankruptcy protection, and it just settled with about, I think, $13.5 billion lawsuit against the 2017 wildfire. And it seems that they are just facing yet another lawsuit filed this morning. And in that case, what happened to PG&E here is that, well, in 2017, their share price was hovering around like $70, $65, $70, and it went down to about $6 to $7 after the Chapter 11 bankruptcy protection. And investors are, of course, very keen on understanding the potential risks of climate change because of the asset value is at risk if it is not taken into account. But the thing is that the scientists have been talking about the increased risk of wildfire for a long time. For example, this is a Science magazine article that shows a warming and earlier spring increase Western U.S. forest wildfire activity. And these papers are not just coming from sporadic papers from obscure journals. These are really major journal outlets that are very well read and well cited, and there are multiple of them. And there has been a good consensus among scientists that climate change will definitely increase the risks of wildfire. And if your transmission lines, thousands of miles transmission lines are, networking over the forest area in western United States, then, well, obviously the climate change related risks should have been factored into the strategy of the company. And I think that it's also very interesting to see that the PG&E was a champion in ESG scorecards. So in many cases, the PG&E was really topped, was the top player in ESG scorecard because of its high percentage of renewables in its portfolio and number of women in the board. All those aspects was done very well in ESG scorecard. But unfortunately, I think that we have to integrate science more into climate science, more into corporate strategy to go forward. So, but wildfire is not the only risk. The Scientific America says that, well, even in California, rising sea level poses even bigger economic threats. So this is why. So this is the simulation with computer graphics by Climate Central. It's very informative. It's Venice Beach. It's a prime real estate. under climate change, this is what scientists expect to happen. So, this prime real estate will be submerged in water, basically loses all the values. And this is quite a significant loss to the investors if you have a piece of real estate in this area. It's not only about California, obviously, other parts of the United States and other parts of the world suffers from similar, physical losses under climate change. A few weeks ago, you may remember that in Texas experienced very unusual cold spell. And as you can see here on the right, this is NASA's image. The Arctic cold air basically spelled over to Texas. There's nothing really work as a barrier. Like there's no big mountain ranges that blocks this cold air, and it was basically inundated with this cold air. At a certain point, the Texas temperature was colder than the Anchorage in Alaska. So this is also related to climate change, as scientists find out that polar vortex become weaker under climate change, and southern states become very vulnerable to these cold snaps, and damages are devastating. The damages from the blackouts are estimated to be at least 195 billion, making it the costliest natural disaster of recorded history in Texas. So we're talking about really big money associated with the climate change. And one of the big challenges of the communicating climate change is that climate change means very different things in different location and times. It can mean increased intensity and frequency of wildfire. It can also mean increased intensity and frequency of drought, storm event, heavy rainfall, temperature anomalies, and it can be a variety of different things depending on where you are and what time we are talking about. Invariably, we are talking about big money and big losses, and investors, of course, cannot ignore this potential risks of their asset value losses. So just how much are we talking about? So obviously there are various different estimates on the cost of climate change, but in general, we are talking about hundreds of trillions. So these are some of the estimates. Depending on the scenario, it ranges from 85 trillion to up to 500 trillion social cost of climate change. Just as a reference, 2018 pre-pandemic gross world product was $85 trillion. So we are talking about huge amount of financial losses, and obviously investors do not want to have their assets losing values due to the climate change. So investors are saying, for example, the BlackRock CEO, who arguably is one of the most influential voices from the investment community, saying, disclose, plan for how your business model will be compatible with a net zero economy. Net zero, will elaborate more on net zero later on. So this is very legitimate and reasonable request from the investors community, and that's where the CDP's a program is coming to play. So recently, CDP has seen a quite substantial uptick in adoption of CDP responses. And last year, nearly 10,000 global enterprises have responded to the CDP questionnaire. And I do believe that there is a very important role that investment community to play in tackling the global challenges of climate change. And CDP is really working as a conduit between the investors and the businesses. So now new CDP season has started, and I believe that many companies already have prepared the data to feed into the CDP questionnaire, and I know that some of the companies we are working with already started to calculate some of the emissions and fill out some of the questionnaires, and some companies are just to start the process right now. So what are the new changes in the 2021 CDP questionnaire? So there was a really nice webinar by CDP, and the slides are already in the CDP website. So I will not go into too much of details, but I will just highlight some of the main changes. And I would like to encourage you to look at the CDP webinar slides on the website. So the good news is that in 2021, changes are very minimal, and 109 out of 115 questions have either no change or minor changes. Um, so the changes you see are in C3 business strategy, and some changes in C4 targets and performance, and the C8 energy. And no question have been removed from the last year's questionnaire. So if you have submitted the responses last year, bulk of the majority of the questions will be very similar or the same as last year. And this is a direct capture from the CDP's webinar. And this was just one example. C2.2, some clarifying script has been added where the respondents are asked to show a case study that demonstrate how the components of the described process have been used for identifying the physical risk as well as the transition risks of climate change. And here's another example of change where new question have been added on the net zero target, which I will talk about briefly later on. Which I think is very important and desirable change. And also there was a change in weights where the targets have increased weights in this 2021 questionnaire for the management and leadership level scores. So about the net zero target, why there is increasing emphasis by CDP on net zero target and carbon reductions? The reason is simple. Scientists very much agree that avoiding dangerous climate change requires limiting the global mean temperature rise to 1.5 degrees Celsius as compared to pre-industrial era. That requires, depending on the scenario, bringing down our greenhouse gas emissions to net zero by around the middle of the century. So, for example, for CO2 emissions, depending on the cases, the window for us to become net zero should be around 2035 to 2075. In some cases, for example, higher overshoot case, the range becomes 2040 to 2065. So let's say by 2050, we have to come down to net zero. And that also means that by 2030, which is not too far away, we have to reduce our CO2 emissions by around half, as compared to 2010 level in the next 9 years. So that's quite steep acceleration in the effort to reduce our greenhouse gas emissions. And if companies are not really prepared to go carbon neutral or net zero at this pace, then the challenge will be compound over time. So we want to set the target early on and plan low carbon transition early on to minimize the abrupt changes and the risks associated with them. So now we are shifting our gears and we'll talk about some of the common mistakes when reporting to CDP. So let's see. So we have been reviewing a lot of CDP questions for our clients, and we help our clients to improve their CDP scores and have maximize their potential in CDP scoring. And these are some of the common mistakes. And these are not only mistakes that we see, but they're some of the common mistakes that we see from our clients, and we would like to share with you. So the first common mistake that we would like to talk about is that, the responses say something, but sometimes even interesting, but does not really answer the question. So I'm sorry that this is not the most intellectually intriguing topic that you want to hear from a webinar, but it is what it is. And when we review the draft responses to CDP, we see a lot of these cases. So let's take a look at some of the real cases. So climate change questionnaire section 2.2 goes like, describe your processes for identifying, assessing, and responding to climate-related risks and opportunities. And see here, this is the rubric, the scoring rubric, 1 to 3 1 to 2 is based on drop-down menus that you have selected, and 3, it is about which risk or opportunities could have a substantial financial or strategic impact. And it should be consistent with the drop-down menu that you have selected. That's 1 point. And then it asks for the case study on physical risks and opportunities, and another case study on transition risks and opportunities for each one for 1 point. Let's look at the real answer from one of the respondents of last year. We redacted the names. It is not about shaming this company or respondents or criticizing their responses. It's all about learning from the mistakes. So I want to give you like 1 minute to read through this response to this question. Okay, so I hope that you have finished reading this answer. So I think that this company is doing a lot. So, for example, it says it integrated climate change into business strategy in early 1990s, and it reduced the company's carbon footprint. Um, and it talks a lot about the energy management and its effort to reduce greenhouse gas emissions, etc. But the thing is that the question is about the process for identifying, assessing, and responding to climate-related risks and opportunities. It's not about whether you have a target and how much effort that you have made in reducing greenhouse gas emissions. So from the CDP scoring partner, they will say, well, thank you for making all this effort, but well, you haven't answered my question. So we cannot give you those points. So here, the company in the end received the D score out of this questionnaire. Um, so it is important to realize that CDP questionnaire is not an invitation to talk about the random acts of sustainability that your company has undertaken. It has very specific purpose, and each question is designed to address some of the core issues on climate change preparedness and the management, carbon management. And it is very important to answer those questions directly as possible. Don't just copy and paste from your sustainability reporting or environmental reporting. So our first tip is read the question and answer as directly as possible. So in order to do that, please try to get familiarize yourself with the scoring rubric and provide the most direct answer to the very questions, or just ask us to help you. So we have a designated team of trained eyes to help you maximize your potential in CDP responses. And again, do not copy and paste general descriptions of your company's environmental effort from ESG or sustainability reports. And it's very important to align your descriptions with the drop-down menu that you have selected. And if when you said, well, those processes affect your business strategy, and you said yes in drop-down menu, and in description there is no mention of how those processes affect your business decisions, then you're not getting the point. So that's the first one that we want to share with you. And the second one is that we see that sometimes efforts are made inconsistently across sections. So this is what we mean by inconsistent efforts. So these are the sections of CDP questionnaire, 1 to 12. And the structure goes like, section 2 and 3 is about risks and opportunities and strategy. And then the section 4 is the targets and performance. And then 5 to 7, these are all measurements. And then section 8 is the energy data and renewables. And then, well, section 10, verification. And 11, 12, these are more about implementation. And these are the essential sections in order to achieve A and B bands. So have you heard of the law of diminishing return? So what that really means is that, well, in order to improve 10% of your score, from 90% is very difficult because you need to get all the points to 100%, right? So the increasing 10% from 90% is very difficult, but increasing 10%, the same 10% from 50% is not that difficult. Because there are a lot of low-hanging fruits. So our recommendation is to really address those low-hanging fruits throughout those sections first, and then move on to the next challenges. And in some cases, we see that companies are putting a lot of effort in one or two sections of these questionnaires, and then make no effort in other sections. Obviously, in that case, you're not really maximizing your potential, and you're not really efficiently allocating your resources for the better scores from CDP. So we recommend to you to make an effort throughout those sections, and really enlist to check the boxes for the low-hanging fruits, and then design your effort to the next level of challenges. So our tip number 2 is to balance your effort across essential sections, and be mindful about the law of diminishing returns. And when resources are limited, I think it's a good idea to set a viable goal. Let's say, well, this year we want to reach, let's say, management level. And then balance the effort to achieve that goal, and what are the points that you have to accumulate throughout the sections to reach that goal. It's really about careful designing and implementing the plan to achieve the goal. Okay, so number 3 is about missing key enablers. So what we are talking about, the key enablers, is this. So have you ever been in the situation where you were assembling an, let's say, IKEA furniture, and then you found that, well, you are missing one, hardware components, hardware parts, or a tool that you need to assemble this. Therefore, the entire furniture cannot be assembled because that little thing. The similar situation might be that when you're playing the video game like Tetris, and that you need that one shape, and that shape didn't come, so that you could not bust a block of blocks. So that's what we are talking about here. So let's look at the structure again. There are very important connections among these sections. Let's say, for example, right in the middle of these sections, these are the measurement sections, isn't it? So these are scope 1 to 3 emissions measurement, the methodology and data, and these sections are essential in scoring targets and performance and verification, because unless, for example, you didn't have scope 3 measured, and many companies haven't measured scope 3, and then there is increasing need for companies to address their scope 3 emissions. In that case, if the scope 3 exceeds 40% of the envisaged total greenhouse gas emissions, which is the most of the cases, the scope 3 needs to be incorporated into target in order for it to be acknowledged by the science-based target. But if you do not have the scope 3 measurement, you cannot score the targets and performance for science-based target, because there is no target unless you have a measurement done. The same is for verification. So unless you have the measurement, there is nothing to be verified. Therefore, you are not getting the verification point. So the measurement is important in its own rights, but also it feeds into other sections. There are scoring opportunities. The same thing is for the risk and opportunities. So many companies haven't done the climate-related risk and opportunity assessment. In that case, you're losing opportunities for developing business strategies, which is very closely tied to risk and opportunity section. And also, you're losing some points from the targets and performance, and carbon pricing and engagement that are also related to risk and opportunities. There is a less chance for you to score those points. So the tip number 3 is, depending on your goal, we would recommend investing in the key enablers for leapfrogging. So in order to achieve the next notch of the band, it is important to invest in those key enablers. So in order to do that, we need to understand the interlinkages among sections in the CDP questionnaire, and strategically target key enablers that are essential for scoring other sections. So for example, in this particular case, you need a long stick the shapes in order to bust this entire block. And those are the key enablers, and you want to work on those key enablers early on so that you are in the situation to be able to score the points in other sections. So those are the general recommendations that we came up with, and then we are again shifting gear, and we'll talk about beyond CDP. So the title of this webinar is reporting to CDP and the beyond CDP. So what are the beyond CDP topics? So I would like to just point out some of the emerging issues. We don't have a lot of time to go over the details, but several new trends that are coming along that I wanted to address. So one is the net zero pledges that are really proliferating these days. A night doesn't pass before we hear another major companies pledging net zero. I think it was last week, Netflix announced that they will go net zero by 2022. 2022 is just like tomorrow. And companies, as we know, like big companies like Amazon, Apple, and Microsoft, many companies announced their net zero pledges of different kinds, and eventually these will cascade down or trickle down to suppliers. And we are already working with some of those companies that are planning to engage their suppliers in their net zero campaign. So if you have not, made the net zero pledges, sometimes your clients may come and get you, and so it is important to monitor those movements and then be prepared for those requests from your clients. And it is rumored, and I think it's quite certain that SEC, Security and Exchange Commission, will put a new requirements on disclosing climate change related risks. And they already have one, but it's focusing on transition risks, but not physical risks. But it seems that SEC is working on developing new requirements on physical risks of climate change as a new requirement for publicly traded companies. And another one about the substantiating environmental claims. It is a European Commission movement, and I will talk about that briefly a little later on. And another one is a carbon border adjustment mechanism, which is a hot topic these days. And the last one is Buy Clean California Act. I will just briefly mention some of these in subsequent slides. So, for example, the substantiating green claims it has been a long initiative by the European Commission. What that really means is that, well, when companies are making environmental claims, it needs to follow certain guidelines, and that those guidelines are based on product footprint methodologies based on life cycle assessment. Therefore, companies cannot make false environmental claims on environmental performance or superiority from the environmental point of view. These need to follow scientific data and methodology based on life cycle assessment. And I think that this can become quite significant barrier for some of the companies in entering European market. Similarly, there is a huge discussion, as you know, within the European Union on carbon border adjustment mechanism, and the U.S. already kind of opined that it is against the European Commission's move to impose border tax adjustment. So basically what it is that, well, basically European countries will assess whether the exporting countries have the similar level of carbon pricing when they export goods to European countries. And if they don't, then, well, European Union will impose border tax adjustment to make sure that the European companies are playing in a level playing field. There is a significant difference among countries in terms of carbon pricing is reflected, and as you know, Sweden is charging more than $120 per ton of carbon, whereas most of the countries are having less than $10 or none. per ton of CO2 emissions. So those differences are viewed as a disadvantage to European companies, and obviously European Commission wants to mitigate those barriers. So this is still brewing. It's not yet final decision. This consultation period opening up. I think public consultation opened up in July. No, not in June. So this is something to keep our eyes on. So Buy Clean California Act is also very interesting. New legislation. This is very interesting time at the moment. It will soon start imposing those requirements from this July. So Buy Clean California Act, many of you are familiar with that. If I can just introduce it briefly to you. It started with the San Francisco Bay Bridge that required 6.5 billion state fund, and it used Chinese steel, and the American steel workers were not very happy about it, and it lobbied in such a way that the DGS, the Department of General Services of the state of California, should require certain threshold for greenhouse gas emissions, so that high greenhouse gas emission intensive, greenhouse gas intensive steels cannot be purchased by, cannot even bid on the state funded project. It is a new type of legislation that other states are also considering. So they just announced this January the threshold based on the data they have collected. So these are the products that needs the maximum limit for their greenhouse gas emissions per ton of product or for their functional unit. And if their product cannot really demonstrate that, well, their product has lower greenhouse gas emissions than these thresholds, they are not eligible for bidding the DGS issued bids. So obviously these requires some life cycle thinking and quantification of greenhouse gas emissions before participating in the bidding process. So as a recap, the investment and finance community is increasingly keen on understanding climate-related risks, and I think this really obvious trend we are seeing. And there is a need for integrating science into corporate risk management strategies alongside the climate change. And we talked about several mistakes and tips when reporting to CDP. The one is to read the questions and provide direct answers as much as possible, and balancing your effort across sections, the law of diminishing returns, and targeting key enablers that understand the connections among questions. So in this, if you're playing Tetris, I hope that by July, you are in this situation rather than the one before, so that you have those key enablers ready to be plugged in and score big down bottom here. So with that, I would like to end my talk, and now give it back to Holly for question and answers.
Yeah, thank you very much, Dr. Suh, for that very informative presentation. Now we're going to move over to the Q&A session, so please do continue to send through your questions using the Q&A function on the right-hand side of the screen. So the first question we have is, if this is the first time reporting, where would you recommend companies to start? What data is needed in-house? Sangwon, you're still on mute.
Thank you. So if you're first time reporting, I would start with some of the basics. Obviously, the measurement is really the key enabler for many sections. So I would like to start with the Scope 1 and 2 emissions. And that one requires on-site fuel consumptions and electricity consumptions. And once that is done, then I would look into Scope 3. There are some easy ways in which you can develop your Scope 3 accounts using your spend data. So most of the companies have spend data, and we can prioritize which items, which line item is more important than others, and we can start from there. And once those measurement is done, then I would recommend working on understanding the climate related financial risks and opportunities, which also feed into other sections for scoring opportunities. And once that is done, then well, it's the target setting will be the next important tasks that also feed into other sections as well. So those would be kind of the sequence that I would take if you're the first respondent.
Thank you. The next question is there a difference judged between carbon neutral and net zero emissions?
Yeah, so net zero emissions and carbon neutral, there's quite of a confusion there. So net zero means that the anthropogenic emissions by the company is basically zero. So basically, if you compare the amount of carbon that you're offsetting or reducing elsewhere as compared to the amount that you're generating, it should equal. So that is net zero. So carbon neutral can be defined in a variety of different ways. In many cases, companies claim carbon neutrality based only on scope 1 and 2 emissions, not including scope 3. So the CDP questionnaire included a new guidance on net zero claims. So we would like to follow that. And the Greenhouse Gas Protocol also issued additional clarification on carbon neutrality and net zero emissions. So we would follow those guidelines. And we have an article that really talks about the difference between net zero and carbon neutrality. We would love to share that with you among the webinar participants after this webinar.
Thank you. Have you found that nonprofit organizations also do CDP reporting, or do nonprofits mainly just do internal emissions calculations for their own reporting and tracking?
Well, to my understanding, any organization can respond to CDP questionnaires, or they can voluntarily report to CDP. CDP is targeting mainly, I think, that for-profit companies and especially Fortune 500 major companies. But yes, nonprofits are able to report to CDP. And by the way, obviously, CDP also has a city section, so municipalities can report to CDP as well. So any organization, the same principle applies. Basically, we have scope 1, 2, 3 emissions and understanding risks and opportunities of climate change and setting the target. That's exactly the same questions can be followed even if you are a nonprofit. Yes.
Are there specific sections that are weighted more heavily than others when scored?
That's a good question. So the scoring is quite complex. As you know, there is a different bands. We have disclosure, awareness, management, and leadership level, and the weights among different sections vary amongst different bands. So I see there is a increasing trend of emphasizing target setting, which I think is very desirable. But the target setting cannot be done without fulfilling some of the other sections, such as like quantification of greenhouse gas emissions. So those interlinkages are very important to realize. So yeah, yeah.
Another question, where would video conferencing and Zoom related emissions fall? Would it be scope 2? What about for those working from home?
That's a great question. Yes. Let's think about this. So Zoom related emissions. So obviously Zoom related emissions, let's say we are working from home and participating in Zoom. And from the accounting point of view, it really depends on who pays the bill. And when we are working from home, it becomes quite tricky. But in principle, if the company pays for the bill, like for your internet and Zoom account and also electricity, then it should be part of the scope scope 3 and scope 2, right? Because scope 2 is to purchase electricity, so companies purchasing the electricity, so it should be part of the scope 2. And Zoom related activities, you're paying for Zoom and also your internet provider, they will be scope 3. But if you are paying it out of your own pocket and without getting reimbursed, then well, it is currently not accounted for in the current setting. So, but that's something to think about. That's a really good question.
Next question is, for scoring, is a company scored for the next level, say awareness, only when all questions in the questions have addressed disclosure level requirements? Or is it for each question, if a company addresses requirements of disclosure for one question, they can be assessed for awareness for that question, even though they may not be addressing requirements for disclosures or other questions?
Gotcha. So the way how the scoring rubric is organized is that well the scoring criteria are different among different the bands. So let's say for the disclosure level, what they are seeing is whether the company is disclosing the information. As long as you disclose the information, you get the points, regardless of the content of disclosure. And then the awareness requires more than just disclosing the information. And management and leadership level obviously expect the company to do much more than just disclosing. So for the same answer, the way how the scoring rubric is organized are different along this different bands of the scores. So it really is important to really understand how the scoring rubric is organized. So the same answer, yes, same answers will be evaluated, but by different set of criteria depending on the level that you are being evaluated. And obviously, if you have not reached the 80% threshold to enter into the next level of evaluation, then you are not evaluated by that level. So depending on your target, for example, if you want to reach leadership level, or if you want to reach a management level, then well, there are ways in which you can kind of optimize your effort to achieve that level of score by understanding, more precisely how those scoring rubric is organized and how do they affect different sections of your questionnaire.
Thank you.
I hope that it
What
answered your question. Yep.
Yeah, it was a great answer. What are the main ways CDP reporting will differ for professional services organizations?
Professional service organizations. So it would be great if the person who asked the question can clarify the professional service
Yeah.
organizations, what it refers to.
Um, the participant said law,
Oh, I,
legal.
I see. Got you. So probably if the participants can, enter that information on the chat box, that would be great. And in the meantime, we can entertain some other questions, and then we can come back on that after we receive some
Uh,
clarification.
Absolutely. The next question is, what scenarios are you using to assess 1.5% for individual companies? There's been some scrutiny and skepticism due to lack of transparency on what SBTI is using as assessment for real net zero calculations. Can you elaborate?
Right. So we are using multiple different scenarios, RCP scenarios that we are largely used by IPCC, and we try to follow those RCP scenarios. And it's important to use multiple different scenarios because, even IPCC, we use a lot of different scenarios. And those graphics that we have shown for net zero windows, it is based on hundreds of scenarios. There are four major ones that IPCC is using, but beside those four major ones, there are a lot of other scenarios. So the results are shown as a percentile among those scenarios. So the 1.5 degree report by IPCC published a couple of years ago shows the result for the 25 to 75 percentile range among those scenarios. And within those scenarios, the probability is shown what is shown on the graph is the probability from the 5 to 95 percentile range. So what that means is that, well, climate change is inherently uncertain. So we don't know exactly what is going to happen in terms of, for example, will there be 30% more precipitation in the regions where my assets are located, or would that be 300% more rainfall? And what is the intensity difference? And what is the frequency difference? All those things are very uncertain. Although there are a lot of different models that are out there, the uncertainty is still generally very high, although science is improving really rapidly. So it is very important for us to use multiple different scenarios in order to make sure that we are making our decisions more conservatively. So I wouldn't recommend like one or two scenarios, but I think that it would be the it would be the best if you can use as many scenarios as possible. And some of the basic scenarios that IPCC uses for RCP scenarios for its forecasting, its projections, obviously those are very useful. But I would also look into some of the extreme scenarios to just see, what is the level of responses, or level of preparedness that my operations need to have in response to those extreme cases.
When a company estimates a portion of emissions because of lack of data, how is that considered when the company's response is being scored?
Yeah, so the rubric does have the coverage of the emissions. So whether the emissions that are covered is less than 30%, or whether that is the over 70% of the total anticipated emissions, the rubric does look into the completeness of your calculation as compared to the anticipated total. And also for the verification, some companies look into verification of only scope 1 and 2. And some companies have a very, limited, let's say, subset of scope 3 verified. That is, of course, encouraged, but obviously the completeness is an important criteria in a variety of different questions.
Thank you. If the company or organization invests in carbon reducing efforts, for example, sustainable gardening for enhanced carbon sequestration, or preventing future emissions by advocating for legislation that, say, bans single-use plastics or establishes 100% renewable energy mandates, but these efforts are not verified as carbon offsets, do those get accounted for?
I mean, those efforts are are useful and important efforts, and I think that the question is whether those efforts are additional and real, and in many cases, um, reductions in greenhouse gas emissions can be very elusive. So, for example, let's say companies are renewing their fleets, and they do that routinely, and new fleets generally have a higher efficiency. Therefore, there is a reduction in greenhouse gas emissions as compared to previous years. Should that be counted as carbon reduction, for example? It is questionable, and in this particular case, I would say it is not an additional reduction. This ongoing effort, that routine effort, in that case, it should not be counted as a carbon offset or carbon reduction. And that's why it is important to follow certain protocol, reputed protocol, and get those emissions reductions verified. And obviously, those efforts are all very, useful, and I think, well, under good intention, but without, following the right protocol and getting those reductions verified, is very difficult to, give credits to those emissions. So, definitely those efforts are great, but I would highly encourage companies to look into existing established methodologies that are out there, like gold standard, if it is voluntary offset market, or the ETS methodologies, and third party verify those emissions reductions.
Thank you. So we have a clarification from our professional services question. So the participant said, as a legal services provider, and a first-time responder, it's unclear to me how our approach to CDP might differ from a company that produces a consumer good, for example.
I see. So the legal service provider, um, well, the one thing about the CDP questionnaire as well as the greenhouse gas protocol, which is underlying methodology for the measurement of greenhouse gas emissions, is that not all sections are applicable to everyone. So legal service provider, for example, you don't have any emissions from the emissions from the sold goods, for example. This is one of the 15 categories of scope 3. There is nothing that is applied applicable to the providers of legal services. But other than that, despite those differences, the general principle of carbon accounting applies to all sectors. So even for legal services, you buy, let's say, computer and notes and pens and papers, and you use electricity, and you may travel. And those are all generating greenhouse gas emissions, and greenhouse gas protocol and the CDP questionnaires are designed to accommodate those circumstances under which greenhouse gas emissions are generated, regardless of the sectors that you are in. And there might be no sector-specific guideline, that you can just follow the general questionnaire and the greenhouse gas protocol to calculate your scope 1 to 3 emissions. So in many cases, I think providers of legal services will be simpler, um, and there will be a lot of sections that are not applicable, so that you don't have to report. So there is a um, option that you can choose relevant into irrelevance, that therefore not calculated. So if it is relevant, then you need to calculate them to score that points. But if it is not relevant, then basically you are given the score regardless.
For a solar power company, if weights of different materials and pre-assembled solar panels is not known, how to account for these sources in the scope 3 emissions?
Got you. Yeah, these are some of the common questions that we are facing. So obviously the best quality data is directly coming from the supplier, and they have compiled their on-site emissions and purchased electricity, and their scope 3, and then, well, that is the best quality data. But in many cases, we are not able to acquire supplier-specific emissions factors. And in that case, we have a whole variety of different databases out there that provide the average data, and that is acceptable by the Greenhouse Gas Protocol and as well as CDP. So what we would do is to look at what are the major components that are out there, and how many of them can be estimated using the databases that are out there. And in some cases, we are not able to find 100% of those components. Then we often use proxy values to estimate them, and these are all accepted by CDP as well as the Greenhouse Gas Protocol, as long as they are well documented. And we also go through with our clients the auditing process, the third-party verification process, and with verifiers, we explain the rationale behind the using the proxy values in the absence of any better data. So these are very common circumstances that our clients are facing.
Thank you. Another question for you. Is nuclear energy considered a renewable or green energy?
So nuclear energy is generally carbon free, but it is not considered as renewable. So if there is a significant portion of your electricity grid that you're purchasing coming from nuclear, definitely that is reflected in your scope 2 emissions, but it will not be counted as part of renewable energy in the energy section, section I think it was 12. So yeah, so definitely it is counted in terms of reduced greenhouse gas emissions, but it is not counted as renewables.
Substantiating green claims is dependent on life cycle assessment, or LCA. However, LCA's methods are still not harmonized across sectors and geographic regions in the world. So how can you manage this situation?
Yeah, this is a big challenge, and European countries have been preparing for this using PEF, as you may have been following. So PEF is the Product Environmental Footprint Standards, and European Commission has been working on developing underlying database and methodologies, and in many cases, product category specific rules and how to calculate life cycle assessment for goods and services. So they are very well prepared, and I think that at the initial stage of this legislation, to my understanding, there will be some kind of grace period where there are opportunities for companies to kind of learn and build their capacity, but eventually, I think that they will require companies to use very specific guideline and databases to ensure, that environmental claims are substantiated based on harmonized methodologies. But this is very hot topic, and obviously, non-European countries are not very happy with this type of movement that kind of mandates the use of European developed methodologies and data. But this is remained to be seen how this will unfold. But you're right that I think that in the end, this will be all about like how to harmonize LCA methodologies and data, and how to align that with PEF guidelines. And this is there are lots of works to be done in order to make this transition happening smoothly.
Thank you. So we're almost at time, so that's all the questions that we have time to get to today, but feel free to send along any questions that we didn't get to Dr. Suh. We will share his contact info in the follow-up email. Also, please note that VitalMetrics is offering a free consultation of last year's CDP report, or if you're new to disclosing, then a one-on-one consultation to give you specific tips for reporting. If you'd like to get in touch with the VitalMetrics team, please make sure to take a moment to fill out the one question survey as you exit the meeting. So thank you so much, Sangwon, for sharing your expertise, and to all of you for joining us today. Have an amazing rest of your day.
Thank you.